Let's dive right into this explainer and unpack that completely wild final trading week of May 2026. If you were watching the tickers on Friday, May 29th, you know exactly what I'm talking about. Everything seemed totally fine, and then boom, the bottom just fell out. Today, we're going to look at the hard data to figure out, are we staring down the barrel of a massive market crash, or was this actually one of the most brilliantly executed institutional traps of the entire year? Just look at this number, 359 points. The Nifty 50 literally plunged 359 points in just the final hour of trading, closing right near the absolute lows of the day at 23,547.75. I mean, if you were holding long positions, that vertical drop felt like an absolute gut punch. It was fast, it was aggressive, and it left a ton of retail traders completely bewildered heading into the weekend. So, it begs the ultimate question, was this a genuine panic crash or a carefully laid trap? Now, on the surface, the reasons plastered all over the financial news made a lot of sense. We had the MSCI rebalancing, triggering mandatory global passive adjustments, plus the IMD downgraded the Southwest monsoon forecast. But in this explainer, we're not just buying that surface narrative. We're going to peek behind the curtain and reveal the hidden game institutions were playing while everyday retail traders were hitting the panic button. Section 1. The crime scene and the footprints. Okay, to solve this mystery, we've got to follow the money. Extreme volume always leaves footprints, right? Look at this massive wealth transfer. Foreign institutional investors seemingly panic sold over 21,000 crore rupees in the cash segment. But wait, domestic institutional investors didn't run for the exits. They systematically absorbed almost 17,000 crore of those blue chip stocks at a massive discount. So while global passive trackers were blindly dumping index heavyweights to meet those MSCI mandates, the active domestic smart monies stepped right in and bought the dip at structural swing lows. And that brings us to a crucial point. This wasn't a trend reversal at all. It was what institutional traders call a liquidity sweep. Basically, it's a manufactured drop. That sudden 359-point plunge, it was designed to sweep right through retail sell-side liquidity, wiping out retail stop losses below 23,600. And by wiping out those traders, institutions got exactly what they needed. Enough liquidity to perfectly fill their massive buy limit orders, waiting in the 23,484 to 23,500 zone, completely without driving the price up against themselves. Pretty wild, right? Section 2. The master plan, the gamma squeeze. All right, so now that the smart money has quietly accumulated shares at a discount, let's check out the options battlefield heading into the new weekly expiry. This is where the trap gets absolutely brutal. Down below, we have a massive protective put wall at 23,500. We're talking over 67 lakh contracts. That is a solid, firm macro floor. But look up top. Because of Friday's rapid decline, aggressive call writers stepped in, betting the market wouldn't go back up, which created these heavily concentrated, highly vulnerable call walls at 23,700 and 23,800. Going into the weekend, those call writers were feeling pretty confident. But here is the linchpin of the entire trap. Thanks to some really positive overnight rallies in the U.S. tech sector, the gift Nifty surged over 200 points, while our local markets were closed. What does that mean? It means Monday is going to open aggressively higher, blowing right past that critical 23,750 make-or-break pivot level. Let's walk through exactly how this classic negative gamma short squeeze is going to play out. Step 1, the market gaps up above 23,750. Step 2, all those late-stage retail momentum short sellers who were induced into holding overnight, they wake up trapped deep in the red. Step 3, remember those massive call walls at 23,700 and 23,800? Those option writers are instantly shoved into severe negative gamma territory, forcing them to buy back their short contracts just to manage their risk. And finally, step 4, all of this creates a frenzied buying loop that rockets the index straight toward the 24,000 ceiling. It's a textbook arbitrage-driven trap. Section 3. Sector shifts. Hiding from the monsoon. Now, the smart money isn't just buying blindly across the board. They are rotating their capital very specifically based on that new macroeconomic reality, the IMD's monsoon downgrade to 90% of the long period average. Institutions are basically grabbing their umbrellas and running to safety in tech. The top 5 strongest sectors right now are IT, pharma, telecom, capital goods, and private banking. IT is totally leading the pack, fueled by Wipro's massive agentic AI deal with ServiceNow and their upcoming 15,000 crore rupee buyback at $250 a share. And defensive sectors like pharma, they're completely insulated from weather worries, making them prime institutional targets. On the flip side, look at what they're actively dumping. The top 5 weakest sectors are PSU power, Metals, PSU banking, FMCG, and energy. Why? Well, a weak monsoon means delayed infrastructure and construction projects, which hits metals hard. But even more importantly, below normal rainfall creates a massive threat of agricultural asset quality stress, meaning potential loan defaults. That really stresses state-owned lenders, so risk-averse managers are quickly trimming their exposure to PSU banks. Section 4, your institutional trading playbook. Okay, so how do you actually navigate this heavily bifurcated market without getting caught in the institutional crossfire? Let's turn this data into an actionable playbook. If you're an aggressive trader, your plan is right here. You're going to want to ride the momentum of that opening gap up. First, wait for the Monday open and confirm that the Nifty can actually sustain above the 23,750 pivot in the first 30 minutes. If it holds, execute long Nifty June futures, aiming for 23,850, while tactically scalping high beta IT leaders like Tech Mahindra and Wipro to ride that US tech tailwind. Now, if you're more of a conservative trader, absolutely do not buy that opening gap. The volatility is going to be wild. Instead, wait for the market to naturally pull back midday to test the high volume point of control at 23,650. If that fair value support level holds strong, that is your green light to build your long portfolio. You'll want to park your capital in defensive, structural leaders like Sun Pharma and Bharti Airtel. To make this super clear, here is the raw data on the absolute highest probability swing setups. These stocks are showing extreme relative strength compared to the benchmark index. We've got Wipro with a 95% probability score thanks to that AI deal, Larsen & Toubro playing off a solid dynamic support bounce, and Sun Pharma acting as your ultimate defensive hedge. Notice the exact entry zones and targets mapped out here. They are all fully backed by heavy institutional accumulation footprints. But, and this is a big but, there is a catch we have to acknowledge. With the India VIX recently spiking over 16 and the RBI Monetary Policy Committee meeting coming up in just a few days, volatility is definitely expanding. So you must strictly follow these Kelly criterion risk metrics. Cap your maximum risk per trade at 1.0% of your portfolio capital and enforce a hard weekly drawdown limit of 3.0%. Seriously, protect your downside so you don't get completely wiped out by a random news headline. Bringing this all together, the overarching institutional verdict is crystal clear. The data spits out an incredibly high confidence score of 82 out of 100. The smart money believes without a shadow of a doubt that the Friday sell-off was just a temporary, manufactured structural anomaly driven by passive rebalancing and absolutely not a fundamental market top. So as that opening bell approaches and the critical 23,750 pivot level gets tested, the market has completely laid its cards on the table. We are literally watching a massive wealth transfer from panicked retail and passive indexers directly into the hands of active domestic institutions. The only question left to answer is, will you be the trapped retail trader fighting the squeeze, or will you ride the wave with the smart money? Keep your eyes on the data, manage your risk out there, and I'll see you in the next explainer.